So I'm Steve.
I'm Riley.
Tax Force is our company. What's the segment called? The segment's called Teaching Riley.
So I heard a client ask this question that I thought was really interesting, and they were asking about what is better, buying versus leasing, and which option is better for them in their business. So I thought that we could use the candy again. And maybe do some examples.
Let's do some examples.
Okay.
The candy, for sure. All right, so let's, what do you want to be? Do you want to be buying or leasing?
I want to be buying.
You want to be buying?
Yeah.
So let's take the example. Let's use 10 again because it's a nice, easy, divisible number. Okay, so buying versus leasing. Ultimately, if we look at the M&Ms being the cost of the purchase and the Maynards being the total number of lease payments made, so the same sort of cost.
Okay.
Over the life of the vehicle or the asset that you're looking at purchasing or leasing, the write-off on taxes does end up being approximately the same. The difference is how it's applied and in what year it's applied.
Okay.
Okay?
Yeah.
So in our previous video, we did talk about capital cost allowance and how you take a mathematical percentage, right, of what's there.
Yeah.
For leasing, it's you just take the lease payments. So if you were to take 30% of your M&Ms, because that's the purchase, doesn't matter when in the year you purchase it, let's say you got 30% of those,
Okay.
right? That's what you get to write up against your taxes. Where for a lease, if I only made 2 lease payments, that's all I would get is the cost of the 2 lease payments.
Okay.
Right? And then the following year, you're going to get mathematically a percentage, 30% of what's left.
Mm-hmm.
And I'm going to get, in this case, let's say it was only a 12-month lease, I'm going to get the rest of it.
Oh, wow.
Right? Now, I'm paying for this vehicle in 12 months in this case, right? I'm showing a 12-month lease payment, where you might have a loan that shows over a longer period of time, or you may have chosen to pay cash and that whole thing was already paid for.
Right.
The point being that leasing matches your cash flow. You're writing off the actual money you're paying out of your bank account. Where purchasing, it's going to be a mathematical percentage regardless of whether you paid cash or chose to finance it.
So then when would you say that one is better than the other?
A great example of when one could be better than the other is if you've bought an asset, go back here, you've bought a vehicle in December,
Right.
you may have only made one little down payment on it.
Yes.
Right?
Yeah.
If I lease a vehicle in December, I've only made one lease payment, let's say.
Okay.
You still get your same 30% to write off.
Because I bought the whole vehicle.
Because you bought the whole vehicle. I only get the one little lease payment.
Okay.
That's it.
Okay. So then in that case, it would be better to buy the vehicle if you can.
Potentially, if you're looking to have a large tax deduction, a larger tax deduction through the purchase of an asset at year's end, purchasing is better than leasing at the end of the year. Your deduction through capital cost allowance is the same no matter when in the year you buy it.
Right.
Where through leasing, it's all based on the number of lease payments that you make.
Okay.
Right? So if you lease in January, you're going to have paid out a lot more, and you're going to be able to deduct that. Where through purchasing, again, depending on whether you paid cash for it or took a loan, it's going to change potentially how much you've actually taken out of your bank account to pay for it.
So if I'm going to get new equipment for my business and I need to decide if I should lease it or if I should buy it, what can I be looking at to try and decide what would be best?
And I think that's a really great question because the key at the end of the day shouldn't be the tax treatment, right? When you're in business, you want to make sure that you can make the best deal on the equipment that you're buying. What vendors do is they're trying to help you figure out how to finance it. Because if you just write a check, then that's easy, right? I own it, here it is.
But instead of focusing on what you can finance separately, month by month or whatever, you should focus on, at the end of the day, what the deal you're getting is.
The deal you're getting is, right?
Okay.
Which includes what am I paying for this, and what am I paying for the money that I'm borrowing to get it, right? So what interest rate am I paying? That's what's most important primarily. After that, for your particular business, there might be advantages to leasing versus purchasing, depending on the contract that you're able to negotiate with the vendor, as well as the needs of your business and the time of year that you're making this acquisition.
Okay, that's a lot to consider when you're trying to get some new equipment.
It is. There really is a lot to consider, and not the least of one is making sure that you're also considering your cash flow. Right there, if you're buying a large piece of equipment, even if you've got the money in the bank for that, you don't necessarily want to pay for the whole thing up front, because under either leasing or purchasing, you're going to have to take only a little bit of that cost each year against your income as a deduction. So,
Right, makes sense. You want to make sure that's actually matching up with your cash flow.
well, you certainly don't want to spend all the money that you have in the bank and then not have the money left to pay your tax bill,
Well,
because
yeah.
you thought that you could write the whole thing off.
Right.
So that's a very important piece as well.
So it depends.
Like so many things, this is where good solid advice comes in, and where you have to realize that your business is unique and individual, and your needs could vary compared to somebody else's.
Right.
So yeah, check with your advisors.